Hey guys, I am joined today with Ashley Ortega. Ashley, thanks for getting behind the camera with me.
Thank you for having me.
You know, we're super jazzed. We want to talk to everybody about adjustable rate mortgages, otherwise known as ARMs. And so I'm gonna let Ashley take over here. Let's just give them the breakdown. Let's give them the definition of what is an ARM.
Okay. What an ARM is it's not a body part.
No.
It's ARM stands for an adjustable rate mortgage. And there's all different kinds of ARMs out there, all different adjustments.
And you don't have to be afraid of them.
No.
You don't have to be afraid of them at all. So there's some benefits. I mean, I think especially right now, we're seeing a lot of people talk about them. There's a lot of popularity in them.
Yes. They're very popular today because interest rates are higher, as we all know. Inflation is up, interest rates are up.
Yeah.
And it's very likely soon that we're going to see inflation come down and rates come down because rates follow inflation. So inflation comes down, rates come down. So with that being said, in some cases, adjustable rate mortgage rates are lower than the traditional 30-year fixed. And why not pick up some savings in your monthly mortgage payment if you know that it's very likely you're going to refinance before your rate starts adjusting on the adjustable rate mortgage? Because really statistically, it seems like people refinance every 3 to 4 years.
3 to 4 years. And really, the National Association of Realtors says that a person stays in their home about 7 years before they move. So that's a little bit higher than when I first got into the business, but 7 years. And if you're refining, you already know you'll probably be refining in 3 to 4 years.
Yeah. And then you can refi into a 30-year fix at that time on the lower rate levels.
Oh, so that's great. First of all, you can get in at a lower interest rate on the ARM. You can reduce your monthly payments, in some cases up to like $250 a month
on average.
On average. And then you keep an eye on the rates, or you have a good mortgage lender like Ashley who calls you up and says, hey, your ARM was at 6.5%, but rates just dropped 5%. Let's do a refi.
Yeah.
And now you can do your 30-year fix.
Yeah. Yeah. And there's no prepayment penalty on the ARMs.
That's a good point.
So I would say like the most popular ARMs today right now, because these two are so conservative, is the 7-year and the 10-year ARM, because you have 7 to 10 years before your rate starts adjusting. So your rate is fixed in, your payment is fixed in for the first 7 to 10 years. And then if you're still in that loan at that time, you haven't refinanced, then that's when it becomes adjustable based on the remainder of that 30-year term. But again, it's very likely you won't stay in that ARM for that amount of time.
Even if you do, the point about this is that you don't have to be afraid of the interest rates. I had a client back in 2010 who called me up, and she was in an adjustable rate mortgage. She's like, I'm really worried. Well, at that time, interest rates had gone down. So I was like, well, I think it's pretty good for you right now. Everybody's locked in at 5%, and yours is going down to 4%.
That's right, because the interest rate will adjust based on the market at that time. So fast forward 7 years, if the indexes are lower, your rate could actually, and payment could actually drop. So it could go up or down.
And we don't have our crystal ball in front of us. Certainly we don't. There's factors outside of the U.S. economy that we can't control. But what I'm saying is that it's not something for you to be afraid of as a buyer. It gives you another product that may help you with a lower interest rate and save money over the duration of that loan. And you can refi out of it as well without a free penalty.
And sometimes adjustables don't make sense. So it's, sometimes adjustable rates, sometimes a 30-year fixed rate is better than an adjustable. Because really with adjustables, where you see them sort of more advantageous is someone putting 20% plus down, and you have a great credit score, and It's a single family primary residence. So all the good.
And you have a good job. Like, you know, your job is stable, right? Like, I mean, let's talk about that because the Fed, you know, wants everybody to lose a job. So, but if you're not in that position, if you're in a position where you know you have long-term growth at a company, then this is also a product that could really make sense to you.
Yeah. And we'll go, you know, this is where I come into play is I would say like 80% of the time when I'm talking to clients, an ARM doesn't make sense. It just doesn't. So there's that small 20% where I'm like, oh, okay, this buyer or borrower is great. You know, they're set up perfectly. And let's see what an ARM looks like. And here's how much you would save on that ARM. And, you know, is that something that makes sense for you or you want to look at?
So make sure you talk to Ashley before you do the final decision. And there, a lot of play is happening right now out there on the 5 and 7 year ARMs, or 7 to 10 year ARMs. And so just be aware of it, and talk to us about it so that we can make sure you're in the right mortgage for you. So if you have any questions, just leave them in the comments below, and don't forget to subscribe and like. So until next time, until we come out with the next most popular topic, we'll see you then. Stay safe.